Hello, welcome back to Core Finance. I'm Matt Brown, joined by Matthew Yeates, Quantitative Investment Manager of Seven IM. Seven is an operative number today. 7 major banks have passed the UK, or the Bank of England UK stress tests. Magnificent 7, I put my teeth in, or not so. RBS and Lloyds just getting over the hurdles?
Yeah, well, I'd say RBS and Barclays actually, I think,
Oh,
passed but without flying colours is probably the name of the game. So these are annual stress tests that the Bank of England runs to make sure basically that banks are now safe institutions and not the precipitators of the financial crisis that we saw so very recently. So it's interesting, I think, if you look into the stress test and what they compose. There's two main elements to it. There's a stress test for just can they sustain a kind of global slowdown in growth, global slowdown in equity markets, and so that sees kind of really quite penal fall. So housing market off by a third. Equities down by 45 to 50%, unemployment up to nearly 10%. So these are really kind of quite stringent stress tests that the banks have to show they can manage. But I think the second set is interesting because the second set really reflects very much the world that we're living in. This is a kind of a prolonged, not necessarily a downturn, a sharp downturn per se, but the other thing they had to show that they were capable of sustaining is global growth, or UK growth at around 1%, interest rates close to 0%. This is the world that banks face nowadays. So I think post-financial crisis, banks have almost been regulated out of existence. It's kind of hit by wave after wave of regulation and kind of legal matters around PPI and things like that, especially in the UK. But it's this macro environment that's increasingly hard for them. You know, with the yield curve, traditionally banks make money off the shape of a yield curve. Why? Because they're lending out at longer dates, you know, at higher rates of interest, and all their interest that they're paying out is on short one-year deposits in many cases. Yield curves are the flattest that they've been almost since the global financial crisis, both in the US and the UK. So I think that world isn't necessarily getting any better, and these tests today, and as you said, kind of RBS and Barclays really just passing it signs that it's really difficult times out there for banks.
And for shareholders, I mean, that's the thing. Now, banks obviously have to perform for their shareholders. They have to make money. They have to pay dividends. As an investor, are the banks just... is that model not working? If you're looking for dividend yield and looking for growth, would you be looking at the UK banking sector at the moment?
Well, I think growth is the one to really focus on there. I think many people are talking about, you know, banks are the new utilities. As I said, they've been regulated out of existence. That, I suppose, exciting bit of the bank's balance sheet, that prop desk activity, has been kind of outlawed really kind of by wave upon wave of bank regulation. I think the banking, on the sort of banking profits and the sort of businesses that banks are trying to diversify and focus into, things like kind of wealth management, less linked, I suppose, to that that idea of what they became pre-financial crisis. You know, these exciting, for the UK, really trying to copy the US model of trying to be this huge, multifaceted investment bank type model. Really, that bit of business isn't as attractive anymore. So I think for shareholders and investors looking at the UK banks, of which, for example, the Chancellor is one of the biggest. You know, the Chancellor has a huge vested interest
RBS.
in the outcome of RBS. As announced last week, they're looking to wind down their £15 billion sale. I don't think they were looking for the same sort of exciting ride that they were into the 2007 crisis. So I think long term, the outlook looks reasonably challenging for banks, certainly to hit that growth story. I think that utility-like profile of banks as an investment going forward is the more apt one.
And in a post-Brexit environment, there's been a lot said about fintech, and this could be the new industry or the growth industry for the UK. Now, having over-regulated banks, is that good for disruptive fintech industries that can potentially come in under, or does that filter down to these smaller industries? If the banks aren't looking at the new technology for their prop desks and risk management, etc., Is that good or bad for these smaller companies?
I think it can only be good. I think what you've got is huge tanker ships of banks that take, very slow moving, very slow turning circles to change their direction over time. And what you've got kind of coming in alongside that are kind of these nimble ships of fintech firms that are doing a much better job of navigating a changing environment. And the pace of change in the fintech industry is massive. Just look at the blockchain and the extent to which people are talking about cryptocurrencies and this new way of really sustaining just currencies, which are the currencies on which all of the traditional banking models are built. I think down in, I suppose, the other end of the spectrum, you have things like peer-to-peer lending. And what are these kind of peer-to-peer lending firms kind of stepping into a place? Well, it's the sort of markets that banks used to be big players in. The loan market, the ability of end banks to be competitive in this loan space because of the regulatory capital and because of kind of just the macro environment is increasingly prohibitive. So stepping into the fore are fintech firms and kind of alternative banking firms. And I think really on the regulation front, I think the regulator has recognised a changing environment, and they're giving a little bit of room to fintech firms. So, the sandbox of regulation in which many of these fintech firms play, and I think is relevant, especially when they can't let a behemoth of a bank play in that same sandbox. So I think they have a competitive advantage on the short term. Long term, let's see. I think the business model for many of these fintech firms is that they grow to a point where they're acquired by one of these large banks.
Understood. So lots to consider there, but well done the 7 major banks. At least they've passed the stress test for now. Hopefully this interview hasn't been too stressful for you. Matthew Yeates, Quantitative Investment Manager at 7IM. Thank you for joining us.
Thank you.